Hey everyone, welcome to Mondays with Monica. I'm Monica Dunlap, your local real estate agent with the Totally About Houses team, Keller Williams. So, first of all, I wanted to say happy Thanksgiving. So, this week, my team and I will be delivering pies to our clients. So, we have over 130 pies going out between tomorrow and Wednesday to our wonderful clients. We appreciate you very much. Now, let's talk about what we want to talk about today. An adjustable rate or fixed rate mortgages. What are the difference and which one is right for you? So whether you're getting your first loan or re-entering the housing market after a long time, choosing a mortgage product is definitely a tricky affair. There are many factors to consider aside from your financial situation, such as current interest rates, how long you plan to live in the home, and so on. So let's talk about a fixed rate mortgage. Okay? A fixed rate mortgage is a popular choice for many home buyers since it's fixed, the payment's fixed for the entire term of the loan. The most common terms are the 30-year and 15-year fixed mortgages. The great thing though about the fixed rate loan is that even if you do a 30-year mortgage, if you make an extra payment every year, you can cut that time down. Or if you make a few, you can easily turn a 15-year mortgage or a 30-year mortgage into a 15-year mortgage. So, what are some of the pros and cons of choosing a fixed rate mortgage? Well, first, a pro is your interest rates and payments remain the same. Your rates and mortgage payments remain the same throughout the life of the loan, so you're protected against the market fluctuating interest rates. Even if the mortgage market turns for the worse, there's no need to worry about paying more interest. For example, right now rates are really, really low, so you can maybe get 2.5% to 3%. However, a year or two ago, we're up to 5% interest. So no matter what happens in the future with a fixed rate mortgage, you get your mortgage today at a 2.5%. That remains 2.5% for the life of the loan. Okay? Another pro for a fixed rate is your terms are just simpler to understand. This is a great advantage for first-time buyers who may feel overwhelmed. So you know exactly what to expect with your interest rate and your principal and interest payment for the life of the loan. And fixed rate mortgages are virtually identical from lender to lender. Okay, next thing, you can always refinance at any time that if you get a fixed rate and you want a lower interest rate. So right now, if you get there's probably not going to be any lower terms. But for example, if you got a fixed rate mortgage 2 years ago at 4%, it'd be a great time to refinance your payment because you're going to save money of the long term of the loan. However, a con for a fixed rate mortgage is that your upfront costs may be more expensive. So despite the security and stability that a fixed rate mortgage offers, they can be more expensive. The typical closing costs and monthly payments are often higher compared to an adjustable rate mortgage, which have a lower interest and lower closing costs. Okay? Because of this, borrowers with poor credit may have difficulty getting a good deal using this mortgage term. So if you have around a 600 credit, an adjustable rate mortgage may be a better one short term for you. So let's talk about situations where a short term or adjustable rate mortgage will be best for you. So for example, adjustable rate mortgages, they are either a 5-year ARM, 7-year, or 10-year ARM. These conditions depend on what your lender offers and specific terms of the loan. So with that, what that means is that, the first number 10, like if it's a 10-year ARM, that indicates the period the loan's interest rate is fixed, while the second number, which would be 1, specifies the annual frequency the interest adjusts after the initial fixed period. For that example, the introductory rate lasts 10 years, and after that, the rate can change once a year, year after year. So if a 5-year ARM, if you have an introductory rate of, say, 2%, that's going to last for 5 years. And after 5 years, depending on where the interest rates and the market rates are, if they're at 10%, your mortgage could go up to a 10% interest rate. Or if they're lower, they could go lower, which at this point in time, they're probably not going to go lower. Okay, so pros and cons. Pros, you'll have a lower initial monthly payment, usually with your fixed rate ARM because your interest rate is lower. Okay, that's a great pro. However, it is a riskier mortgage. You need to know what you're getting into when you choose an ARM. It can be a gamble because while the initial interest rate is fixed for a specific amount of time, it is highly possible at higher interest rates in the future, just like we talked about. The uncertainty makes it riskier than a fixed rate mortgage. However, the potential increase in your interest rate will depend on the terms of your loan. Home buyers, you guys should evaluate whether you can handle these associated risks, or if there's enough wiggle room in your budget in case your interest does go up. So another thing is your loan terms can be more difficult to understand with an adjustable rate mortgage. Now, what would be some situations where an ARM might be best for you? If you're planning to relocate soon, that may be a great time to get one, because if you're going to move in 3 years and you have a 5-year ARM, well, you're going to plan on selling within 3 years, so it won't affect your interest rate. So that's a way where an ARM will be a good thing for you. Also, if you want to get a larger loan to purchase a nicer home, lenders can use the lower rates and payments early in the loan terms when qualifying buyers. So as opposed to, you may not be eligible for a fixed rate mortgage, but you may for an ARM on a certain home. Okay, and like we just talked about, if you're anticipating a lifestyle change, that could definitely be, an ARM could be more beneficial. So fixed rate versus ARM, which one is better? Well, ARMs have some appeal, especially to younger first-time buyers who want a lower initial payment flexibility. Make sure, though, that your income can handle the higher payments when the rate increases. Okay? Otherwise, a fixed rate mortgage remains the ideal option if you don't want to go beyond the boundaries of your budget to own your dream home. For both loans, you and your lender will need to carefully assess your financial situation for your long-term plans when choosing one over the other to make sure which is the better option. Now, again, I do have great lenders that can help you. So if you're looking at the two or have questions, please let me know. I'm happy to also get you in touch with one of my great lenders. I hope this is helpful. And again, happy Thanksgiving, everyone. I appreciate you. And for our current clients, look forward to those pies being delivered. Hope everybody has a fantastic week. Thanks.